right, so in this section, we're going to talk about companies that are like groups of companies that are controlled by maybe by one company, or they're like kind of equally controlled, like subsidiaries, subsidiary companies where one company controls another company, and the treatment of those depends upon how much of the subsidiary is being controlled. So parent subsidiary groups, this is where there's a common parent corporation that owns either directly or indirectly, and it can get kind of complicated when you're talking about indirectly, at least 80% of one or more other corporations. You remember those questions that they had on the tax return where it was asking about other corporations, like in percentages and stuff? It's because of these rules where those questions are. So here's an example. Garcia Company owns 90% of Harnett Company. So it means somebody owns another 10%. The two corporations are part of a parent subsidiary group. Okay, so as long as Garcia owns at least 80% of Harnett, it's considered a parent subsidiary group. Garcia Corporation also owns 95% of Iona Company. So they own 90% of Harnett and 95% of Iona Company. Iona owns 85% of Jasper Corporation. So because it's more than it's at least 80% of each of those, directly or indirectly, the entire chain of corporations is part of a parent subsidiary group. The benefit of being a parent subsidiary group is they can file just a single tax return rather than filing a bunch of different tax returns. So it's called a consolidated tax return. There's a special form for it, Form 1122, attached to the first consolidated return for each of the subsidiaries. So all members of the parent subsidiary group have to be included, though. You can't just exclude one of the members of it. Then the subsidiaries do not file separate tax returns. In this case, what they do is essentially all of the income, all of it's included in the group tax return. It has advantages. So on a consolidated return, if one entity is generating a lot of income and another one is generating a bunch of losses, you put them together and that income is reduced because of the losses. So they can benefit from each other. So they can offset the profits and losses of each other. Profits from intercompany sales are also deferred. So if there's sales between them, you don't have to include that as income at that point. The election is binding on future tax years. Any losses on intercompany sales cannot be recognized, and any elections that are made by the parent are binding on all of the subsidiaries. Okay, so, but for the most part, it's the thing to take away from this is that parent subsidiary group, they get to file a consolidated tax return, which is a lot easier, and then they can offset gains and losses on each other's. Okay. Then we have these brother-sister groups. So if 5 or fewer persons own 2 or more corporations, then we have a brother-sister group if these two tests are met. So the total ownership test and the common ownership test. Shareholder group owns stock representing at least 80% of the voting shares of stock, or at least 80% of the total value of all shares. So the entire group owns 80% of these corporations. And then there's the common ownership test. The shareholder group has common or identical ownership of more than 50% of the voting power, or more than 50% of the value of all shares. We've got an example that we're going to go through to kind of help illustrate this. So the 80% test examines the ownership of an individual corporation. Who owns 80% or more of the corporation, right? So if this one group of people owns 80% or more of the corporation, then that total ownership test is met. The 50% test is based on the smallest common percentage across all of the corporations that we're looking at. So it's across all of them. So let's look at an example here. We've got 3 individuals and 4 corporations. So what you would do, and if you look at it in a spreadsheet format, it makes it a little bit easier. So here's the percentage that our 4 corporations, the percentage that each person owns up to, so these, we've got 3 companies, these 3 individuals together own 100% of these 3 companies. And then company D, these same 3 individuals own 90% of these 3 companies. Okay, so the identical ownership, I think that is the same as the common ownership. So with the total ownership for each of these companies, yes, these people own more than 80%. So that has been satisfied with the total ownership test. Shareholder group owns stock representing at least 80% of the voting shares of stock. So that is true of all of these. They own 100, 190. So that's true. Over here, they're calling it identical, common ownership test. So what you do is you take the lowest number across. So in this case, it's Reed with 20%. The next one is both Smith Smith owns 30% of each of those, so 30%. And then here, the lowest number is Thomas with 10%. Take the lowest of those and add them up. If it's more than 50, then both of those tests are met. Okay. So the smallest number across the column, it's the identical ownership across all of the corporations. So for example, Reed owns at least 20% of each of the corporations, right? So at least 20%. So his minimum for all 4 of these corporations is 20%. It is met because the 3 individuals own at least 80% of the 4 corporations, and the common ownership test is because the common ownership is more than 50%. So it's 60% in this example. So the 4 corporations are all part of a brother-sister group. So you can think of it as they mentioned here. So 80% test is a vertical test. So add all of the ownership up, whereas the 50% test is a horizontal test. It's also a vertical test because then you have to add them all up vertically. So they file individual tax returns. However, see, there's a limitation on the brother-sister groups. IRS realizes that the common control within a brother-sister group can result in income or expense being inappropriately allocated between members of the group. They can finagle the income and expenses from these because they control them, right? So the IRS with these brother-sister groups has the authority to reallocate the income, deductions, and credits of the related corporations. So they can come in and examine and say, you know, this expense in Corporation B should actually be with Corporation A. Because it's not a parent subsidiary where you can do a consolidated return. So you don't have that ability to combine those items of income and expense. So what is this? Okay. So this is probably, I mean, the parent subsidiary is a little bit easier to understand, but this one, like I said, it's a vertical test and then a horizontal test, but then vertical as well at the end, because you gotta add them all up. All right, questions about those? Business interest expense limitation, and this applies to all types of businesses, not just corporations. So business interest expense is deductible as long as it does not exceed business interest income plus 30% of adjusted taxable income. Okay, so this is to limit the amount of expense that is deductible in any particular year. It is carried forward indefinitely, so any amount in addition to that is carried forward indefinitely. And it's, so the adjusted taxable income is considered to be taxable income before the business interest income or expense and before any NOL deduction as well. It only applies to companies with 29 million or more, or over $29 million of over 3 years average. So for this example, Barcelona Corporation, ATI 50,000, business interest expense of 10,000, business interest income of 1,000. Limitation is equal to the sum of business interest income, which was $1,000, plus 30% of ATI, which is $15,000 for a total of 16,000. Because the business interest expense of 10,000 is less than that, they can deduct all the business interest expense. Plus, they don't meet the gross receipts threshold for having to this. Now, again, assuming that the $29 million limitation doesn't apply, Calgary Company has ATI of 20,000. Now, I don't know why. Hold on a second. This is weird because I think this should be that it does apply. Well, anyway, here's an example where it does apply. I don't quite understand the 29. It says it doesn't apply, but then it's saying it does apply in here. So, but let's just assume it does apply. So in 2023, Calgary Company ATI of 20,000, business interest expense of 13,000, business interest income of 1,000. So their limitation is equal to the sum of business interest income, which was $1,000 here, 30% of ATI. So ATI was 20,000, 30% of that is 6,000 for a total of 7,000. So they would only deduct, if it applied, would only deduct 7,000 of the business interest expense rather than the 13,000, and then the remaining would be carried forward. The IRS giveth and the IRS taketh away. Well, Congress giveth and the IRS taketh away. All right. Questions about that? I don't quite understand their example there because it like I said, it only applies to, it doesn't apply to any business with average annual gross receipts for the prior 3 years that is 29 million or less. And yet they're applying it here. So I don't quite get that. Questions?